Imagine making this really substantial profit on a stock, right?
Oh, the dream scenario.
Right. But then because your portfolio manager clicked sell just, I don't know, 48 hours too early, the government legally confiscates almost double the tax.
Yeah, that happens way more often than you'd think.
And you did absolutely nothing wrong. The underlying company is performing brilliantly.
Right, the fundamentals are solid.
Exactly. The market is up. But simply because of this invisible calendar ticking away in the background, your actual take-home wealth takes this severe hit.
It's brutal. It really is.
So welcome to this deep dive into the source material. Today, we are looking directly at that invisible math that dictates what you actually get to keep.
Because that's all that really matters at the end of the day.
Exactly. We're decoding the mechanics of taxation within portfolio management services, or PMS. And we're basing this entirely on the framework laid out in Chapter 11 of the NISM series XIA workbook, specifically the September 2025 version.
Which is, well, it's the ultimate invisible drag on performance, honestly.
Right, because people obsess over returns.
Oh, completely.
Mm.
Investors will obsess over finding a portfolio manager who can beat the benchmark index by, maybe 1 or 2%.
Yeah, they do these deep dives into their philosophies.
Right. They interview managers, they analyze past performance, they scrutinize everything. But then they completely ignore the fact that a poorly optimized tax strategy within that portfolio can easily wipe out 3, 4, or even 5% of their net return.
It's like pouring water into a leaky bucket.
That's exactly it. The tax code is not just, a set of rules for compliance. It is an active, living variable in the formula for your wealth generation.
And the really fascinating part to me, looking at the source, is that the tax department doesn't even look at the investment first.
No, they don't care about the asset yet.
Right. Before they assess the stock or the bond, they assess the person holding it. The very foundation of your tax liability rests on how the state categorizes your existence, basically, within its borders.
Yeah, we are talking about the jurisdictional net.
The net. I love that term.
It's very accurate. Because the fundamental philosophy of the Indian Income Tax Act is residency-based taxation.
Okay.
But it has this distinct flavor of global reach for people who are, fully tethered to the country.
So it categorizes investors into a few different buckets, right?
Right. 3 primary ones. You've got resident individuals, non-resident Indians, and non-individuals like corporate entities or trusts.
But the resident individual one is where it gets tricky.
Very tricky. It's the most nuanced and honestly the most frequently misunderstood category because it splits into 2 distinct statuses.
Okay, break those down for us.
You have the ordinary resident and the not ordinarily resident.
Let's unpack the ordinary resident first, the ROR, because this is the all-encompassing net, isn't it?
Oh, absolutely. If you fall into this category, the taxman really does not care where your wealth was generated.
Right. You could be sitting in a high-rise in Mumbai, but earning dividends from, say, a tech startup in Silicon Valley.
Exactly. Or collecting rent from a commercial property you own in London.
And the Indian government still claims taxing rights on that.
Yes, on your entire global income.
Wow, just because you live there.
Precisely. Because your primary economic and physical anchor is within their jurisdiction. And to determine this, the tax code relies on a really strict mathematical threshold.
It's not about how you feel about the country.
No sentiment involved whatsoever. The primary test is the 182-day rule.
Okay, 182 days.
Yeah. If you are physically present in India for 182 days or more in a single financial year, boom, you are a resident.
Which, I mean, that sounds straightforward enough. You just count the stamps on your passport, right?
You'd think so, yes.
But the government knows that high net worth individuals, the people usually using a PMS, they have the resources to be highly mobile.
Oh, very mobile.
So if the rule was just 182 days, a wealthy investor could just live in India for 180 days, spend the rest of the year in like a zero-tax jurisdiction like Dubai or Monaco, and completely bypass the global net.
Which is exactly why the secondary condition exists. It's a total anti-abuse mechanism.
To catch the tax tourists.
Exactly, to catch the tax tourists. If you try to game the system by keeping your annual stay artificially short, the government looks backward.
Oh, they look at your history.
Right. If you stay in India for at least 60 days in the current year, and then 365 days or more cumulatively over the preceding 4 years, you trigger residency.
Oh, wow. So you can't just hop in and out forever.
No, you cannot. Suddenly, your entire global portfolio is dragged right back into the Indian tax calculation.
Okay, so that's the ROR. What about the not ordinarily resident, the RN/R? This kind of seems like a transitional status when you read the text.
It often is. It usually applies to individuals who are maybe returning to India after a really long stint abroad, or expats working in India temporarily.
Got it. And for an R&R, that global net is lifted, right?
Correct. You are generally only taxed on income earned or received in India.
But there's this crucial caveat in the NISM text, and I feel like it catches a lot of people off guard.
The controlled from India clause.
Yes. It says an RNOR is also taxed on income derived from a business controlled from India. What does that actually mean in practice?
That specific phrase, controlled from India, is the battleground for just countless tax disputes.
I can imagine. It sounds so subjective.
It can be. Let's say you're an R&R, right? And you have a thriving e-commerce business registered in the UAE.
Okay, UAE, zero tax, basically.
Right. The servers are there, the customers are there, the actual revenue is generated there. But you are currently living in Bangalore, and you are the sole decision maker.
Ah,
You're taking the strategy meetings over video calls, you're approving the budgets from your laptop in a coffee shop in Bangalore.
so the economic nexus of the business might be in the Middle East, but the cognitive control, the brain of the operation, is happening in India.
Exactly. And that is all the Indian tax department needs.
Really, just the decision-making location.
Yes. They argue that the intellectual capital driving the profit is situated within their borders. Therefore, the control is in India, and that foreign income gets pulled right into the domestic tax net.
That is wild. It forces investors and business owners to be incredibly meticulous about where they literally sit when they make decisions.
It really does. You have to be so careful about where board meetings are officially held and where strategic directives are signed.
Okay, so the taxman figures out who you are, they cast the net, and once you're in it, they start examining the contents of your portfolio.
Right. They look at what you actually own.
And this is where the rules of the game just fragment completely. It seems like the tax code looks at a government bond and an equity share as if they belong to entirely different universes.
The great divide between debt and equity, it's really the defining structural feature of Indian capital gains taxation.
Why are they treated so differently fundamentally?
Because the government historically utilizes tax policy to incentivize specific types of capital allocation.
They want to guide where the money goes.
Exactly. Equity is risk capital, right? It builds corporations, it funds innovation, it drives GDP growth.
Yeah.
So the tax code rewards equity investors. They give them shorter holding periods and lower tax rates. Debt, conversely, is viewed as safer, more passive capital.
Okay, let's start with debt then, because the landscape here underwent a seismic shift recently.
Yeah, a massive shock to the system, yes.
According to the updated workbook, which reflects the July 2024 budget changes, the holding period to qualify for long-term capital gains, or LTCG, on a debt instrument is 24 months.
Right, a full 2 years.
And if you hold it for more than 24 months, you pay a flat 12.5% tax on the gain.
Correct. But if you sell it in 24 months or less, it's classified as a short-term capital gain.
And short-term is much worse.
Oh, much worse. That profit is simply added to your total income for the year, and it's taxed at your applicable slab rate.
Which for most PMS investors is the highest bracket.
Exactly, which could be upwards of 30%. But the truly revolutionary change, the one that fundamentally altered how portfolio managers construct fixed income strategies, was the complete removal of the indexation benefit for debt.
Right, July 2024. To understand the magnitude of that, we really need to understand the mechanism of the shield that was taken away.
The inflation shield.
Yeah. Historically, indexation was this profound acknowledgement by the government that inflation silently erodes your wealth over time.
It was a very fair accounting mechanism.
Right. It allowed you to artificially inflate your purchase price based on a government-notified cost inflation index.
Let's walk through the actual mathematics of how that used to work, because it really highlights the current pain point for debt investors.
Okay, hit me with the math.
Imagine you bought a debt instrument for 100 rupees. You hold it for 3 years, and you sell it for 130 rupees.
Okay, so you have a 30 rupee nominal profit.
Right. But over those 3 years, inflation was running high. The government's inflation index might dictate that your 100 rupee purchasing power from 3 years ago is actually equivalent to 115 rupees today.
Because things just cost more now.
Exactly. So under the old rules, you wouldn't pay tax on the full 30 rupee profit.
Right, you'd adjust your purchase price up to 115.
Yes, your taxable gain shrinks from 30 rupees to just 15 rupees.
So you were only paying tax on the real inflation-adjusted growth of your capital.
Precisely. It was an incredibly powerful tax shelter. It essentially guaranteed that debt investors wouldn't be penalized for macroeconomic inflation that was totally beyond their control.
But with the July 2024 changes, that shield was just confiscated.
Completely gone. Today, using that exact same example, you buy at 100, you sell at 130.
The tax department ignores inflation entirely.
Completely ignores it. You pay a flat 12.5% tax on the full 30 rupee nominal gain.
Wow. Which really forces a radical reevaluation of debt within a PMS, doesn't it?
Oh, it changes everything.
If a manager is buying a bond yielding 7% and inflation is, say, 5%, the real pre-tax return is only 2%.
Right, but you're paying tax on the full 7.
So the after-tax real return starts inching perilously close to zero.
Sometimes even negative in real terms. It fundamentally shifts the purpose of debt in a high net worth portfolio. It moves from being a tool for wealth accumulation to pure, simple volatility mitigation.
A shock absorber for the equities.
Exactly. You're holding debt strictly to ballast the portfolio when equities crash, knowing full well that from a tax perspective, it is now a highly inefficient asset class.
And we also need to distinguish between capital appreciation on debt, like selling the bond for a higher price, and the actual interest payouts, the coupons you receive while holding it.
Oh, definitely, because interest is treated with even less leniency.
Yeah, the workbook clarifies that interest earned is categorized under income from other sources.
Right. There is no long-term benefit for interest.
No 12.5% rate.
None. Every single rupee of interest you earn is taxed at your slab rate from day one.
So if you're in the highest bracket, you're just forfeiting a third of your yield immediately.
Just handing it over. Which is why, for individuals in the highest tax brackets, receiving regular interest payouts is incredibly punitive.
It almost makes you want to avoid regular interest.
It does. It actively drives the demand for growth-oriented debt instruments, where the return is realized as a capital gain upon maturity or sale, rather than periodic interest.
Because then you can at least access the 12.5% LTCG rate after 24 months, even without the indexation.
Exactly. It's a strategy of deferral.
Okay, so that's the somewhat brutal landscape for debt. Let's contrast this with the treatment of equity, because the government actively wants domestic capital flowing into the stock market.
Oh, they roll out the red carpet for equity, comparatively.
The rules soften considerably. First of all, the threshold to qualify as long-term is slashed in half. You don't need to wait 24 months.
No. For equity, the finish line is just 12 months.
If you hold a listed equity share for more than 12 months, the gain is long-term capital gains, taxed at that 12.5%.
Right. And there is actually a structural sweetener built in to encourage retail participation and shield smaller gains.
The exemption limit.
Yes. The first 1.25 lakh rupees of long-term capital gains across your entire equity portfolio in a financial year is completely tax-free.
Oh, nice.
Yeah. You only apply the 12.5% rate to the gains exceeding that 1.25 lakh threshold.
But if you lack patience, or if your portfolio manager decides to actively trade and you sell that equity within 12 months, you trigger short-term capital gains.
And the rate jumps significantly. It goes to a flat 20%.
And no exemption limit applies there, right?
None whatsoever. First rupee is taxed at 20%.
Now, this is what fascinates me. This creates an intense behavioral distortion at the margins. It introduces this algorithmic complexity into how a portfolio manager has to operate.
It really does. It becomes a game of chicken with the calendar.
Let's examine this timeline vulnerability. Suppose your PMS manager buys a block of shares in a mid-cap manufacturing company. The thesis is strong, and the stock appreciates by 40% in just 11 months.
Okay, a huge win.
Right. It has hit the manager's internal valuation target. The fundamental, purely rational investment decision is to sell, lock in the 40% gain, and reallocate the capital elsewhere.
Absolutely.
But the tax calendar introduces a massive conflict of interest. The manager looks at the ledger. If they sell today, on, say, day 335, you pay 20% of that profit to the government.
Because it's short term.
Exactly. But if they just hold the position for 31 more days, crossing the 365-day mark, your tax liability drops to 12.5%.
That is a 7.5% absolute difference in the tax bill. It's huge.
It forces the manager to play a dangerous game of probability.
They have to calculate the risk of the stock price declining over the next month against the guaranteed mathematical certainty of those tax savings.
Because if the stock drops by 5% while they were waiting for the tax clock to run out, the investor's actually worse off than if they had just paid the higher short-term tax on the larger gain.
Exactly. And this is exactly where tax lot accounting becomes an absolute non-negotiable necessity.
Because a PMS doesn't just buy a stock once, right?
Rarely. They might accumulate shares of, say, Reliance Industries across 20 different trading days over a 6-month period.
So they have different batches of the same stock at different ages.
Exactly. So when they finally decide to trim the position, the question is, which specific shares are they selling?
And the tax code has a rule for that.
Oh, yes.
Mm.
It strictly enforces the first in, first out, or FIFO method.
FIFO.
Right. If you sell 100 shares, the tax department assumes, for calculation purposes, that you sold the oldest 100 shares in your DMAT account.
They don't let you pick and choose the most tax-efficient ones manually?
No, you cannot cherry pick. So the portfolio manager's software must track the exact acquisition date and cost of every single tranche to optimize which sales trigger short-term versus long-term gains.
It requires a level of computational bookkeeping that is entirely invisible to the client, but it's absolutely vital to their net returns.
Oh, it's the engine room of a PMS.
And while the manager is calculating these holding periods for capital gains, the underlying companies are also periodically distributing profits directly to the shareholders as dividends.
Right, the cash payouts.
How does the tax code view those dividends now?
Well, historically, dividends in India were subject to a dividend distribution tax paid by the company itself.
So they were tax-free for the investor.
Exactly. The company took the hit. But the regime shifted back to a classical model of double taxation.
Double taxation.
Yeah. Today, the company pays corporate tax on its profits, and then when it distributes the remaining profit as a dividend, that dividend is taxed again in the hands of the investor.
At what rate?
At their applicable slab rate.
So again, up to 30% or more.
Yes. And to ensure compliance, the government mandates a toll booth before the money even reaches your account.
The TDS.
The tax deducted at source, yes.
Yeah.
The workbook notes that if your total dividend income from a single company exceeds 5,000 rupees in a financial year.
Which isn't much for a PMS portfolio.
Not at all. If it exceeds that, the company is legally obligated to deduct a 10% TDS before transferring the funds to you.
Just skimming it right off the top.
Right. It's a mechanism to capture revenue upfront and force the investor to declare the income on their tax return to claim any adjustments.
Though the text does specify that this threshold is slated to increase to 10,000 rupees starting from the financial year 2025-26.
Which slightly reduces the administrative friction for smaller investors, but for a PMS client, it's still just a drop in the bucket.
Okay, so if your portfolio manager is buying bonds, holding stocks, and collecting dividends, the framework is complex, but it's conceptually linear. You're generating capital gains and income from other sources.
Right. It fits into neat little boxes.
But what happens when the manager decides that simply buying and holding isn't enough?
When they get active.
Yeah. What if the market is super volatile and they want to hedge your portfolio? They step into the derivatives market, they start trading futures and options.
And this changes everything.
The moment they execute that first F&O trade, the tax department completely alters its perception of who you are.
This is perhaps the most critical distinction in the entire workbook. The Income Tax Act does not recognize derivatives as capital assets in the traditional sense.
Hey, really? Even though they're based on the exact same stocks?
Exactly. Even though you are trading contracts based on the underlying equities, the moment you trade a derivative, your profits and losses are classified as profits and gains from business or profession.
Commonly referred to as PGBP.
Yes, PGBP. You are now a business.
This requires a profound mental pivot for you, the investor, because it's like the tax man saying, buying shares in a pharmaceutical company makes you a passive landlord waiting for the property value to appreciate.
Right, and the government encourages that passive capital formation.
But trading a call option on that exact same pharmaceutical company makes you an active, frantic bakery owner.
Or an insurance underwriter. You are actively pricing risk, you're leveraging capital, and you're trading on short-term volatility.
You are no longer an investor in their eyes. You are running an active business operation.
The rationale is deeply rooted in macroeconomic stability. The government views high-frequency leveraged derivative trading as inherently speculative.
Too risky for the general public.
Exactly. So by categorizing it as business income, they tax the profits at your individual slab rates.
Which, again, are significantly higher than the 12.5 or 20% capital gains rates.
It is a deliberate structural disincentive against excessive speculation by retail and mid-tier investors.
But here's the thing. The defining characteristic of running a business, especially a highly volatile risk pricing business like F&O, is that you can, and frequently will, incur significant losses.
Oh, inevitably.
So how does the tax code, which is so punitive on the upside here, handle the downside of this business?
Well, this is where the business classification transitions from being a huge burden into a highly strategic risk management tool.
Okay, I'm listening.
The tax code allows for the set-off and carry forward of business losses.
Set off and carry forward.
Yes. If your PMS portfolio incurs a net loss in the derivatives segment for the year, you are permitted to set off that loss against other business income you might have,
Oh, wow.
or even income from other sources in that exact same financial year.
Let's contextualize this for the listener because this is powerful. Suppose I run a really successful logistics company, okay? It generates a substantial taxable profit.
Okay.
But concurrently, my PMS manager took some aggressive hedging positions using options, and the market moved totally against us, resulting in a severe F&O loss for my portfolio.
Right, a bad year in the market.
The tax code actually allows me to merge these two completely unrelated activities on my tax return,
It does. You can subtract your PMS derivative loss from your logistics company profit.
effectively lowering my overall taxable business income.
Exactly, and reducing your total tax liability for the year. It provides a synthetic hedge across your entire economic life.
That is incredible. But there has to be a catch.
There is a massive catch. The government foresaw a huge loophole here and built a fortified firewall to prevent it.
What's the firewall?
You can set off derivative losses against almost any other income, with one absolute uncompromising exception: salary income.
Oh. You can never offset an F&O business loss against your salary.
Never.
Let's explore why that firewall exists because it makes perfect sense when you think about it.
Yeah.
Imagine a CEO of a publicly traded company earning a salary of, say, 5 crore rupees a year.
A very healthy salary.
Right. That salary is highly visible, it's easily taxed via TDS every month, and it's guaranteed revenue for the government.
It's their most reliable tax base.
If there were no firewall, this CEO could just instruct their PMS manager to take highly speculative, negative expected value derivative trades.
Just go wild in the options market.
Right. If the trades win, great, they make more money. But if the trades lose massively, the CEO would simply use those paper losses to wipe out the taxable base of their 5 crore salary.
Exactly. The government would essentially be subsidizing the executive's gambling habit with lost tax revenue.
Right. So by strictly prohibiting the set-off against salary, the tax department protects its most reliable revenue stream.
While still allowing genuine business owners to manage their aggregate risk.
But what if I'm a salaried professional, without a logistics company on the side? What if I have no other business income to offset these F&O losses against in the current year?
That's a very common scenario.
Do those losses just evaporate? Does the tax benefit just disappear into the ether?
No, and this brings us to one of the most powerful long-term wealth preservation mechanisms in the code, the carry-forward rule.
Okay, the carry forward.
If your derivative losses cannot be fully adjusted in the current financial year, you are legally permitted to carry those unadjusted losses forward for up to 8 subsequent assessment years.
8 years. So it functions kind of like a deferred tax asset. You are depositing those losses into a conceptual tax bank account.
Precisely like a tax bank account. Let's project a 3-year scenario to see how this works. Year 1, the market is highly erratic, the manager's hedges fail, and your F&O book takes a 10 lakh rupee loss.
Ouch. And I have no business income to offset it.
Right, so you carry it forward. Year 2, the market flatlines, minimal trading, break even. Year 3, a massive bull run. Your manager leverages futures and generates a 15 lakh rupee profit in the derivative segment.
Fantastic. But normally, I would owe slab rate taxes on that entire 15 lakh.
Normally, yes. But because you diligently carried forward the loss from year 1, you withdraw that 10 lakh loss from your tax bank account.
I apply it against the new profit.
And you only pay tax on the remaining 5 lakh rupees.
That is a phenomenal advantage.
It is, but it hinges entirely on compliance. You cannot simply claim a loss 3 years later if you didn't formally declare it when it actually happened.
Oh, so you have to file the paperwork immediately.
You have to file your income tax return on time before the due date, specifically declaring that loss in the year it occurred to establish the legal right to carry it forward.
The administrative burden is non-negotiable.
It really isn't. Which leads us to the most daunting aspect of having your PMS trades classified as business income, the specter of the tax audit.
Just the word audit makes people sweat.
Oh, absolutely. When individuals hear that they're generating business turnover through their PMS, they immediately envision having to hire a team of chartered accountants to pore over ledgers and verify thousands of algorithmic trades that they didn't even personally execute.
It's a completely valid fear. The Income Tax Act Section 44AB mandates audits for businesses exceeding certain turnover thresholds to ensure they aren't underreporting profits.
Right.
But how does turnover even work in the context of derivatives? It's not like selling physical goods where the sale price is obviously the turnover.
That's a great question. Derivative turnover is calculated in a highly specific, somewhat counterintuitive manner.
How so?
It is generally the absolute sum of all positive and negative differences from your trades.
Wait, absolute sum. So if I make a 1 lakh profit on one trade and a 1 lakh loss on another, my net profit is 0.
Correct. Your net profit is 0. But your turnover for audit purposes is 2 lakhs.
Oh, wow. Because they add the absolute values together?
Exactly. Because PMS managers trade frequently, this aggregate turnover can balloon incredibly rapidly, pushing investors toward audit thresholds even if their actual capital base is relatively small.
Okay, the workbook outlines 3 distinct audit scenarios to help navigate this anxiety.
Yeah.
Let's break them down. Case 1 addresses the smaller portfolios.
Right. If your derivative turnover is less than 2 crore rupees in a financial year.
So what triggers an audit in Case 1?
In Case 1, an audit is only mandatory under a very specific combination of factors. If you opt out of the presumptive taxation scheme,
Okay.
and your declared profits are less than 6% of your turnover.
Indeed.
And your total overall income still exceeds the basic tax exemption limit.
That seems like a very narrow set of conditions.
It is. The government designed this to target individuals who might be fabricating massive turnover with razor-thin margins to artificially declare business losses while hiding wealth elsewhere.
So for a standard PMS investor with a modest F&O allocation, this audit trigger is rarely hit.
Very rarely.
Then we move to Case 2, which seems to act as a massive protective umbrella for the vast majority of mid-tier and even high net worth investors.
The sweet spot.
This covers turnover between 2 crore and 10 crore rupees.
This is where the government's push toward a formalized, digitized economy provides incredible relief. Under Case 2, if your turnover is between 2 and 10 crores, you are completely exempt from the mandatory tax audit.
Completely exempt. Under what condition?
Provided that over 95% of your total business receipts and payments are conducted digitally.
And by the very structural design of a portfolio management service, 100% of the transactions are digital.
Exactly. The investor wires money into a bank account, the manager executes trades through a demat account via digital exchange, and the clearinghouse settles the funds electronically.
There's absolutely no physical cash changing hands on a trading floor.
None. And because the entire ecosystem leaves a perfect, immutable digital footprint, the tax department trusts the broker's ledger.
They don't need an auditor to double-check the computer.
Right. They do not require a chartered accountant to manually verify what the digital exchange has already perfectly logged. This 95% digital rule shields almost all standard PMS investors from the nightmare of a corporate-level audit.
But the shield has a limit. The tax department's leniency ends when the volume becomes systemic. That's Case 3.
Case 3 is the hard ceiling. If your derivative turnover exceeds 10 crore rupees in a single financial year, an audit is strictly and unconditionally mandatory under Section 44 ABA.
Unconditionally. So it doesn't matter if your trades were 100% digital.
It doesn't matter if you made a massive profit or suffered a devastating loss. At that sheer volume of financial velocity, the government demands that an independent chartered accountant formally sign off on the books.
To verify the integrity of the data being fed into the system.
Exactly.
Okay, so to summarize the journey so far, the government figures out where you live, they penalize you for holding debt by stripping away inflation protection, they incentivize you to hold equity with lower rates, but punish you for trading early by hiking the rate by 7.5%.
It's a lot to keep track of.
And then they completely recategorize you as a business owner the second your manager touches an options contract.
It's dizzying.
Throughout all of this, your portfolio manager is the one navigating the minefield, right? Calculating the FIFO lots, managing the derivative turnover, executing the strategy.
They're doing the heavy lifting.
But running this complex financial operation requires paying the operator. You pay management fees, performance fees, setup fees.
Nothing is free.
And this leads us to what is arguably the most frustrating aspect of the entire system for an investor. Let's move to Section 4. The bitter pill of fees and expenses.
Oh, this is the part that really infuriates people. because it violates the intuitive logic of how people assume finance works.
An investor naturally assumes they will be taxed on their net profit.
Right. Of course. The money that actually lands in their pocket after all expenses are paid. But for resident individuals generating capital gains through a PMS, the fees paid to the portfolio manager are explicitly and unequivocally non-tax deductible.
Non-deductible. The income tax department basically operates in a vacuum when it comes to capital gains.
Complete vacuum.
They calculate the tax strictly as the final sale price of the asset minus the initial acquisition cost. Period. They refuse to acknowledge the frictional cost of generating that gain.
The government's philosophical stance is that capital gains are passive income. In their view, an asset appreciates due to macroeconomic factors, market dynamics, or company performance.
It does not appreciate because you paid a fee to a guy in a suit.
Exactly. Therefore, unlike a manufacturing business where you can deduct the cost of raw materials or employee salaries,
Because those are essential to the business.
right. The cost of hiring a financial professional to select and manage those passive assets is considered a personal expense. It's not a cost of improvement to the asset itself.
Let's run a detailed mathematical scenario here to expose the true compounding drag this creates on an investor's wealth.
Math time again.
Imagine an investor allocates 1 crore rupees to a PMS. The manager has a phenomenal year and generates a 20% gross return.
Great year.
So the portfolio grows by 20 lakhs. Now, the manager charges a standard 2% fixed management fee on the total year-end asset value.
Okay, so 2% of 1.2 crores.
Right. That fee is 2.4 lakhs.
A rational investor looks at that and thinks, okay, I made 20 lakhs, the manager took 2.4 lakhs, so my net profit is 17.6 lakhs. I should pay capital gains tax on 17.6 lakhs.
Seems perfectly fair.
But the tax code demands you pay capital gains tax on the full 20 lakhs. You're paying tax on phantom income.
Phantom income. Money that never belonged to you because it was contractually owed to the manager from day one.
Exactly. And the mathematical punishment doesn't end there.
It gets worse.
Because managing a portfolio is classified as providing a financial service, the fees attract the goods and services tax, the GST, at a hefty 18%.
Oh, right, the GST.
Continuing our calculation, that 2.4 lakh management fee attracts an 18% GST, adding another 43,200 rupees to the cost.
Wow.
So the total cash outflow for fees and taxes on those fees is over 2.8 lakhs. And this entire 2.8 lakh amount is deducted directly from your post-tax capital.
So you pay the capital gains tax on the gross profit, and then you pay the manager and the GST authorities out of whatever is left over.
Yes. It creates a massive divergence between the gross return the PMS advertises on its fact sheet and the actual net return the investor experiences in their bank account.
Now, you mentioned earlier that there is a slight structural workaround, an exception to this non-deductibility rule, but it requires a very specific entity structure.
Yeah, there is a loophole of sorts. The non-deductibility rule strictly applies to individuals filing under the head of capital gains.
Okay.
However, if an investor establishes a corporate entity, say a private limited company whose explicit registered primary business objective is the trading and investment of securities, the landscape changes entirely.
Because suddenly the entity isn't generating passive capital gains, it's generating core business income.
Exactly. When a corporate entity whose business is trading hires a PMS, the management fees, performance fees, and even the GST can often be claimed as legitimate business expenses.
Because they are costs wholly and exclusively incurred for the purpose of running that specific business.
Right. They reduce the gross profit before the corporate tax rate is applied.
So why doesn't everyone just do that?
Because establishing and maintaining such a corporate structure involves significant compliance costs, audit fees, and regulatory filings of its own.
It's expensive to run a company.
Very. It is generally only viable for ultra-high net worth family offices, which leaves the standard resident individual to just swallow the bitter pill of non-deductibility.
So as a resident individual, you are dealing with different holding periods for debt and equity. You're calculating FIFO lots to the exact day, tracking derivative turnover for audit thresholds, banking unadjusted losses for 8 years, and paying taxes on phantom gross gains while ignoring the GST-laden fees.
It is a complete administrative labyrinth.
If the average investor had to manually calculate this on an Excel spreadsheet, the entire PMS industry would collapse overnight. No one would invest.
No one would have the time, which is exactly why the regulatory framework mandates that the burden of this computational nightmare must fall on the portfolio manager, not the investor.
Let's talk about Section 5, keeping the books straight.
Right, the reporting and compliance. Under the Securities and Exchange Board of India, or SEBI, Regulation 30, portfolio managers are legally bound to provide comprehensive periodic taxation reports.
This is not an added puck or a premium service.
No, it is a fundamental compliance pillar.
These reports act as the ultimate financial translation devices. They ingest the chaos of thousands of microtransactions and output a clean, structured document that tells your chartered accountant exactly which numbers to plug into which boxes on the income tax return.
A compliant tax report must meticulously dissect the portfolio's activity. It must clearly bifurcate realized gains from unrealized gains.
Because you only pay tax on what's realized.
Exactly. It must categorize the realized gains into long-term and short-term buckets, separating debt instruments from equity instruments, because, as we've discussed, the rates and holding periods are vastly different.
And it has to isolate the derivative turnover too, right?
Yes, and the resulting business profit or loss to enable those carry-forward mechanisms we talked about. It must detail every single rupee of dividend and interest income earned, and it must transparently list the exact quantum of fees deducted and the GST applied.
It's a lot of data.
Mhm.
And the timing of these reports is critical. The regulation requires quarterly reports to be delivered within 30 days of the quarter ending, along with a comprehensive annual report at the end of the financial year.
Right.
But from a strategic standpoint, which of these reports is the most actionable for you, the listener?
The annual report in April is really just for compliance. It's what your account uses to file. But the most strategically vital report is actually the Q3 report.
The Q3 report.
Yes, which you receive in January, covering the period up to December 31st.
Why the Q3 report specifically?
Because it gives you a 3-month window before the financial year closes in March to engage in tax loss harvesting.
Tax loss harvesting. Walk us through that.
You look at the realized short-term capital gains generated over the first 9 months. If your manager has generated massive short-term profits, you are staring down a heavy 20% tax liability.
Yeah, you're going to owe a lot of money.
Right. So you then review the portfolio for unrealized losses, positions that are currently down but haven't been sold yet.
You essentially instruct the manager to deliberately sell the losing positions, realizing the loss, and then immediately reinvesting the capital into similar but not identical assets.
Yes. By realizing the loss before March 31st, you offset those massive short-term gains, dramatically lowering your impending tax bill while still maintaining your overall market exposure.
But if you wait until the annual report in April to realize you have a huge tax liability.
The financial year has already closed. The window for harvesting losses is firmly shut, and you are forced to pay the tax. The Q3 report is your early warning system.
Furthermore, the portfolio manager must also provide Form 16A or corresponding TDS certificates.
Yes, crucial documentation.
If the companies in your portfolio deducted 10% tax on your dividends before paying them out, you need official proof of that deduction. Otherwise, when you file your returns, the tax department will demand you pay tax on those dividends again.
The TDS certificate proves the toll was already paid at the gate. Transparency and structured reporting are really the only things that make the complexity of Chapter 11 remotely manageable for the end client.
Okay, everything we have dissected so far operates under the assumption that the investor is physically and economically anchored within India's borders, dealing in rupees, subject to the standard resident rules.
The domestic investor.
But India is one of the fastest growing major economies on the planet. There's a massive diaspora of non-resident Indians in Dubai, London, Singapore, New York, who want to deploy foreign capital into the Indian growth story.
And they should.
But when capital crosses sovereign borders, the tax code morphs into an entirely different beast. Let's open the NRI playbook.
For an NRI, navigating Indian capital markets involves satisfying two distinct masters. You have the Income Tax Act, which obviously wants its share of the profits.
Right.
And then you have the Foreign Exchange Management Act, or FEMA, which is enforced by the Reserve Bank of India.
The RBI.
Yes, and the RBI is obsessed with tracking the flow of foreign currency in and out of the country.
Traditionally, the gateway for an NRI to invest directly in the Indian stock market is a heavily monitored facility called the Portfolio Investment Scheme, or PIS.
The PIS is essentially a regulatory choke point.
How does it work?
If an NRI wants to open a standard brokerage account and click buy and sell on individual stocks themselves, they must route every single trade through a designated PIS bank account.
Why? What's the point of that?
The primary purpose is to ensure that the aggregate foreign ownership in specific Indian companies does not breach sectoral caps mandated by the government.
To control foreign ownership levels.
Right. But the administrative friction is immense. Banks charge hefty fees for PIS transactions, the reporting requirements are draconian, and it makes active direct trading incredibly cumbersome for the NRI.
But the NISM workbook highlights a structural bypass that makes the PMS route incredibly attractive for foreign capital.
It does.
It explicitly states that while PIS approval is mandatory for direct stock trading, it is absolutely not required for investing through a SEBI-registered portfolio management service.
This is a deliberate, highly logical regulatory exemption. The RBI understands the mechanics of a PMS.
In a PMS, a regulated domestically licensed professional is making the investment decisions and handling the clearing and settlement.
Exactly. The regulatory oversight shifts from monitoring the individual foreign investor to monitoring the registered portfolio manager.
By removing the PIS requirement, the government removes the heaviest layer of administrative friction, allowing NRIs to deploy capital efficiently through professional managers.
It's a huge advantage for the PMS industry.
So, the NRI bypasses the PIS friction, but they still have to bring the money into the country and open a bank account to fund the PMS. And this decision, choosing between the two primary types of NRI accounts, is the most consequential architectural choice they will make.
They must choose between an NRE account and an NRO account.
NRE stands for non-resident external. NRO stands for non-resident ordinary. The distinction dictates the fundamental liberty of the capital, repatriation.
Right. Can you get your money back out?
Let's look at the NRE account. I view this as a two-way superhighway. The NRI wires US dollars or dirhams into the NRE account. It gets converted to rupees and invested in the PMS.
And the defining feature is that the capital is freely repatriable.
Freely repatriable.
Yes. Both the principal amount invested and the profits generated can be converted back into foreign currency and transferred out of India at any time.
No questions asked.
Without seeking special permission from the RBI, subject only to paying the applicable capital gains taxes, of course. It offers complete liquidity across borders.
Contrast that with the NRO account, the non-resident ordinary account. If the NRE is a superhighway, the NRO account is kind of like a financial roach motel for capital.
That's a vivid way to put it, but accurate.
Money checks in easily, it earns a return, but getting it back out across the border is an agonizing process.
An NRO account is typically utilized by NRIs who have legacy income generated within India.
Like what?
Perhaps they inherited an apartment in Delhi and collect rent, or they receive a pension from previous Indian employment. That localized rupee income must be deposited into an NRO account.
And they can use those funds to invest in a PMS.
They certainly can. However, repatriating the principal or the profits from an NRO account back to their foreign country of residence is subject to a strict overarching limit.
What's the limit?
$1 million per financial year.
And even within that $1 million limit, you can't just wire the money out, right? You have to endure a bureaucratic gauntlet.
Oh, absolutely. You need a chartered accountant to issue specific certificates, Forms 15CA and 15CB, proving beyond a shadow of a doubt that every single rupee of tax owed on that money has been fully paid to the Indian government before the bank will authorize the foreign transfer.
The friction is very intentional. The government wants to retain domestic capital, but the structural differences between NRE and NRO extend far beyond repatriation. They heavily influence the tax rates, specifically regarding interest and dividends.
Right. The text highlights some very specific tax rates for NRIs that diverge from the resident norms we discussed earlier.
What are we looking at?
Well, the taxation of NRIs is complex because it often depends on whether they opt to be taxed under the special provisions of Chapter 12 of the Income Tax Act or the standard provisions, and how the double taxation avoidance agreements, or DTAA, apply based on their specific country of residence.
It's a web.
It is. But looking at the specific figures cited in the NISM workbook regarding certain NRI schemes, it notes short-term capital gains on equity at 15% and long-term capital gains at 10% on gains exceeding 1 lakh rupees after 12 months.
Those figures reflect historical rates tied to specific PIS and Chapter 12A provisions, demonstrating how parallel tax universes exist within the code, depending on the precise legal mechanism the foreign capital uses to enter the market.
But the most severe tax penalty for an NRI is reserved for the NRO account.
Tell me about the NRO penalties.
The NRO account is treated with intense fiscal aggression. Any interest earned on the balance in an NRO account is taxed at a flat, uncompromising 30% plus applicable cess and surcharge.
30% just on the interest.
Furthermore, any dividends credited to the NRO account are subjected to a massive 20% tax deducted at source. The government takes a fifth of the corporate payout before the NRI even realizes it occurred.
Which brings us to the ultimate strategic collision regarding NRIs and portfolio construction. We established earlier that portfolio managers often use futures and options to hedge risk or generate alpha.
Right.
We also established that F&O is taxed as business income. But here's the regulatory trap. NRIs are strictly prohibited from trading derivatives through a freely repatriable NRE account.
That's the trap.
If an NRI wants their PMS manager to trade F&O, they are legally forced to use the restricted NRO account.
It creates a compound disincentive that fundamentally alters how NRI portfolios are managed. Think about the cascade of negative consequences here.
Okay, lay it out.
If the manager trades options, the profit is classified as business income, taxed at high slab rates. Because it's an NRO account, any idle cash earns interest that is taxed at 30%.
Ouch.
And finally, whatever post-tax profit is left is now trapped in the non-repatriable ecosystem, subject to the $1 million limit and the whole chartered accountant certification process.
It's a logistical nightmare. If I am an NRI based in Singapore, looking at that matrix of taxation and restriction, I would explicitly instruct my PMS manager to avoid the derivatives market entirely.
And that is exactly what happens in practice. The vast majority of NRI investors opt for pure, long-only equity strategies funded through an NRE account.
They just willingly sacrifice the potential risk mitigation benefits of derivative hedging.
Purely to avoid the punitive tax rates and the repatriation trap of the NRO route. It is perhaps the clearest example in the entire workbook of how tax regulations don't just tax an investment, they actively dictate the investment strategy itself.
We have dissected a truly staggering amount of structural complexity today. We began by establishing the jurisdictional net, understanding how the subtle distinction between an ordinary resident and a not ordinarily resident hinges on counting days and pinpointing exactly where cognitive control of a business resides.
We examined the vast chasm between debt and equity. We analyzed how the historical removal of the indexation benefit for debt transformed it from a tax-sheltered wealth accumulator into a highly inefficient, pure volatility buffer.
We explored the 12-month boundary for equity and the intense algorithmic pressure placed on portfolio managers to optimize tax lots using FIFO accounting to secure that 12.5% long-term rate.
We navigated the derivative curveball, dissecting the macroeconomic philosophy that treats a passive shareholder as an investor, but an active options trader as a business owner.
We explored the vital necessity of the 8-year carry-forward rule for F&O losses and the protective shield of the 95% digital rule that saves most investors from mandatory tax audits.
We confronted the mathematical reality of non-deductible fees, demonstrating how the combination of capital gains taxes on gross profits, compounded by an 18% GST on management fees, creates a severe drag on the net realized return.
We highlighted the absolute necessity of SEBI-mandated quarterly tax reports to navigate this labyrinth, specifically utilizing the Q3 report for strategic tax loss harvesting.
And finally, we decoded the NRI framework, outlining how the PMS structure beautifully bypasses the heavy friction of the portfolio investment scheme, while outlining the stark strategic choices forced upon foreign investors by the repatriable nature of NRE accounts versus the high-tax, restricted reality of NRO accounts.
Understanding these mechanisms is the absolute difference between perceived wealth on a broker's statement and actual wealth in your bank account.
The tax code is not merely an administrative hurdle. It is the terrain upon which the battle for compounding returns is fought. Ignorance of these rules just guarantees a lower trajectory of wealth accumulation over a lifetime.
Which leave you with a final, somewhat uncomfortable dynamic to consider the next time you review your portfolio's performance. The entire structure of Chapter 11 creates a systemic tension between fundamental asset quality and tax optimization.
It's a real conflict.
Does the relentless pursuit of tax efficiency sometimes blind us to the actual decaying quality of an underlying investment? If a portfolio manager chooses to hold on to a fundamentally deteriorating stock for an extra 30 days simply to cross the 12-month long-term capital gains threshold, they might succeed in saving you 7.5% in taxes.
Right, they get the tax win.
But if the stock drops 15% while they wait, the tax victory is a mathematical illusion. The pursuit of the optimal tax rate resulted in the destruction of actual capital. It is a delicate, probabilistic balance that requires constant vigilance. Something to critically evaluate the next time you look at the dates in your tax report. Never let the tax tail wag the investment dog.